Good afternoon. The time is 12:30 p.m. Australian Eastern Standard Time, and you're listening to Angus Geddes. And a very warm welcome to all of you joining me today on this audio. Well, we've had another fantastic week, really, for equities, with most stock markets around the world rallying on and making new medium-term highs. Markets in Europe have done well. The US markets, the Dow, the S&P 500, have reasserted their near-term bullish uptrends and made new medium-term highs. And also, after a sell-off in Japan with the Nikkei losing about 200 or 300 points on Thursday, also bounced back to make new highs. So, all in all, the overall tone, the positive tone on which markets began the year after the US government managed to resolve the fiscal cliff has remained intact, and we're seeing bullish performances from most equity markets. I think whilst stock markets now are becoming near-term overbought, and the probability is increasing that we will see some form of a correction, I think that we're still going to see some more length and duration in this rally. It really says a lot about the power of the quantitative easing that has been unleashed by the world's central banks and the amount of liquidity that's being pumped into the system. And I want to talk a little bit about that on today's audio. We've had the Bank of Japan and Japan being the latest country to announce that they're going to step up their quantitative easing programs to bring down the value of the yen. And so far, they've been very successful in just talking about it, because the yen has lost a substantial amount of ground against the US dollar, falling from around 77 against the greenback to nearly 90 as I record this audio today. And of course that has put a rocket under the Nikkei, which has rallied some 2,000 points in the space of a few months. Now, what was interesting about some of the comments from the Bank of Japan this week is that they are going to adopt a modified version of quantitative easing, and that is specifically what they are going to do is print yen to buy international bonds. So they will buy US treasuries and bonds issued by the ECB, and of course they will print yen to fund those purchases. And with that increased amount of yen circulating on the foreign exchange market, that is going to bring down the value of the currency. What was interesting, though, was that they also said that they were going to stimulate the economy through quantitative easing measures in other areas. In other words, they were going to buy other asset classes such as equities. So I think this is one of the reasons why we need to keep an eye on Japan, because I believe it could be the best performing stock market of all the stock markets in 2013. And accordingly, we've been long. I've had a long position in Japanese equities for a number of months now, and I will continue to do so while the dominant underlying trend is up. Also, it's worth highlighting that from a valuation perspective, the Japanese stock market is a value investor's dream, with many of those large public companies selling at less than their breakup value and less than their book values. So I think much stronger days ahead for Japan. What is going to be good for the rest of the world is that with the world's third largest economy, if they are successful in stimulating that economy, and I think they will be, that essentially brings a third major economy back into the global growth picture. And I think that will be very good for stock markets generally and sentiment. If we have a situation where the Japanese economy is growing again after decades of stagnation, then that is going to feed the bull market that is going to, I believe, is going to occur this year. That will continue to occur and run and dominate stock markets this year. The other interesting point I want to highlight from the week is the German Bundesbank's decision to basically repatriate all German gold in foreign vaults. And now, I think this is significant. This is a significant development, and I've highlighted in previous occasions the importance to the gold market and the foreign exchange markets of China's decision to not allow gold exports outside the border. In other words, all gold production in China, and China is the world's largest gold producer, must be sold to the government. Now, that really is a fundamental endorsement of gold bullion as an important component of their monetary reserve base. And I think that this is the first step in China's strategy, basically to remonetize gold and maintain some form of gold reserves as a backup to the currency. And of course, now that Germany has decided to repatriate their reserves, their 3,000 tons of gold, I think this is also a sign that they want their gold bullion that backs up, that forms part of their reserve base, to be in their country, in the country of origin in terms of the ownership. And I think this also sort of says that what we could be looking at in the next few years is gold becoming highly political as an asset class, because you can draw a line in the sand. There are countries that have gold, and there are countries that don't have a lot of gold and are printing a lot of money, and then there are countries that have a lot of gold, like the United States, but are printing a lot of money and debasing their currency. So I think, this is a significant development. The other point I want to highlight about what Germany's doing is it also puts a spotlight really on the derivative gold market. There's a lot of paper gold or paper contracts or claims over physical gold trading and are in circulation, but where conversion to the precious metal may have a question mark over it. And what I'm really talking about is no one really knows the size of the true short position in the gold bullion market, where people have borrowed gold and sold it short. But it is a sizable market. So I think there's also some overtones of that risk behind Germany's decision. Anyway, I think we've got to watch the space closely. The gold price is pushed up to $1,690 this week. It's still trading within a range, and until it sort of gets above 1,700 convincingly, I think that it will continue to consolidate. But I do believe we are getting close to the point where it's going to have another push up against that 1,800 level and then go beyond that level. So these are very interesting times. I think we're in for a further upside in stock markets in the short term, but stock markets are overboard, and I wouldn't surprise if we had a correction or a small correction of some sort, and then I think we're going to get a bigger correction later this year when we move into the second quarter, which is seasonally a weakish period for equities, and I think that will prove to be true again this year. I have not yet raised my cash balances. I'm sitting on some good gains across the board, really, and a lot of our stocks have moved up quite strongly in the past 5 or 6 months since those lows of last year. But at some point probably will be prudent to take a bit of money off the table and take some profits. But I think there's probably further upside to go yet, so I don't intend on changing any of my positions in the near term. And on that note, I wish all of you the best of weekends, a restful weekend, and I look forward to joining you same time next Friday. Bye for now.